Good afternoon, everyone. Welcome to the second retiree webinar for the 2021 season. I want to thank you for joining us and congratulations on your upcoming retirement. My name is Bob Christoffel, the Manager of Benefits Education at Wespath. With me is Frank O'Brien, a benefits educator who will be co-presenting this important material. Hi, Frank.
Hello, Bob. Hello, everyone.
We have a lot of information to cover with you. I do want to remind you that this webinar is being recorded. So if you want to watch it again and pause and slow it down to absorb some of this important content, that link will be released probably later on today or early tomorrow. We want to encourage you to ask questions. On Tuesday's webinar, we had a lot of questions come in. Please use the question functionality that's in the toolbox. When I am speaking, Frank will be and Todd will be behind the scenes working the questions, and then when Frank presents later, I will work the questions. We do have some important attachments there as well related to the housing allowance, UMPIP, CRSP, Life Stage, and Ernst & Young EY Financial Planning Services. So having said all that, we'll get started. Just a lot of information to cover. I'm going to begin by just looking at the 2021 retirement process, how that works, and how these retirement plans at Wespath turn into monthly income. We're going to review all the plans and tell you what the elections are, if you can wait on these plans, which plans you should take right away. We'll talk about different calculations, different annuity types, cost of living adjustments, all those choices that you're going to have to make at some point. We'll talk about Life Stage Retirement Income, which is a great service to convert your consolidated defined contribution balances into a monthly direct deposit. Frank is going to cover an important tax break for retired clergy, the housing allowance exclusion. We have a great example of how that works. Then we'll go into benefit processing. When actually will you see money in the bank, both initially and then on an ongoing basis? The last topic we're going to do is a benefit access demo, where I want to just take you into benefit access, show you the screens, help you find the guy with the glasses, which is the portal to make your elections. That section is really optional. I do realize that some of you, a lot of you, have already been into benefit access. Maybe you've made your elections. So if you've already done that and you feel comfortable with benefit access, you don't need to stick around for that last segment, totally optional. So the retirement process, hopefully you are ready. Hopefully you've notified the bishop, the annual conference, the Board of Ordained Ministry. Hopefully you've registered for benefit access, because that's where the process will go through. Benefit access. We've made it easy to register and just as safe and secure. Occasionally we'll come across a retiring clergy person that has not registered yet, so it really is easy to do. You don't need to do it today, but at some point, you need to go into benefit access and indicate your elections. Please, please do not wait until Wednesday, June 30th at 3 p.m. to do so. Here we are, May 6th, plenty of time to think about it, to consult with benefit educators, to call EY, to speak to your spouse or someone you trust financially. This is a step in the process, joining this webinar. We also have a retirement team dedicated to the retiring class at Wespath that you can call for any assistance. Everything eventually will have to go through benefit access to make those elections. This is just a screenshot from benefit access. You would either be logging in, or if you have not registered, click on the new user registration, provide some information that you should have. If it's you, you'll get a code to your mobile device, enter the code, and you're off and running on benefit access. Once you're in benefit access, I would encourage you to verify that all your personal information is correct, that it's updated. If you're going to be moving, you're going to want to update your addresses. Maybe your email addresses are changing, your beneficiary designations. Make sure your spouse's information is also correct. And that's important, because your spouse is entitled to receive survivor benefits from some of these plans. So you want to make sure your spouse is listed there. And if it's your will, to have that person listed as your primary and sole beneficiary for those account balance plans. You want to take a look at your clergy service record. the record of your appointments over the years and make sure that is correct and accurate. And why does that become real important? Well, Wespath relies on that clergy service record to calculate some of your benefits, to determine what your creditable services, years and months. And I'll give you an example of that when we talk about the Clergy Retirement Security Program. Also important to update, make sure it's current, your life stage profile. Many of you are using life stage investment management, and you can continue to do that in your retired status. Make sure particularly that the risk tolerance is appropriate for you. Are you conservative? Are you moderate? Are you aggressive? Because likely you will still have balances, account balances still invested during your retirement. Check in if you haven't already with your annual conference on healthcare plans. Obviously that is real important. Make a call to EY, Ernst & Young Financial Planning Services. If you have more complex tax planning issues, if you're trying to determine how much you can afford in housing, or the best way perhaps to secure a down payment on housing, make those calls to EY. Many of you will continue to be eligible for EY services in your retirement. Frank is going to talk a little bit about EY later on in the webinar. Also, schedule a benefit education consultation. This is a program that began over a year ago, and it really has been, I think, a magnificent program to assist clergy that are retiring, to help you along the way, especially last year. I mean, things are greatly improved. Last year, it was very negative, a lot of doom and gloom. Here it's more positive, but if you want to meet where you can actually see someone, either myself, Frank O'Brien, or Todd Creviston, these are virtual, private, 30-minute increment consultations. And many of our retiring clergy have taken us up on multiple consultations. We can share our screen, we can help you register, help you find the guy with the glasses, walk you through the elections. So a link will be provided. Very easy to sign up for these consultations. We have plenty of slots available between now and the end of June, but please, again, you don't want to wait until the end of June. We have plenty of availability in May so that we can really help you get comfortable with the decisions that you are making. Ultimately, you want to find this guy with the glasses, and those of you that have been in benefit access, you've seen this guy with the glasses, and maybe you've made your elections and they're just sitting there now as pending actions. But here is what that looks like, that box. We used to have this very small green review button. Now we have this box, so it's much easier to find. That's your portal. You want to click on that box and it brings you in to just the benefits you have access to. And we've had really good luck with the technology. I'm going to show you where that gentleman with the glasses resides. I'm going to take you through maybe life stage retirement income and maybe either CRSP or the ministerial pension plan, just walk you through making elections. So that gentleman becomes real important. And now we can start to talk about money, but really retirement income. And where is it going to come from? It's going to come from different sources, maybe outside of Wespath, but many of you will be getting significant income from the Wespath retirement plans. And this chart I continue to really like because it shows you all of the plans. Some of you might have just CRSP. Others will have CRSP and MPP. Still others I know will have a pre-82 benefit coming. And hopefully you've taken advantage on the right, the voluntary plan, the United Methodist Personal Investment Plan. So I'm going to at first just give you an overview of the plans and then go into more specific details about each of the plans. And the arrow on the slide will tell me what plan we're going to talk about first, and it's indicating the Clergy Retirement Security Program. Some participants call it CRSP, 2 different boxes representing 2 different periods of service. And what I think has always been so interesting about CRSP is that it is both a defined benefit plan, and that is not on your quarterly statement. Okay, it's a formula benefit, which we'll look at. It's a lifetime benefit. You can't outlive that. Some participants call it the pension, monthly income for lifetime, and if elected, continues uninterrupted to your surviving spouse. but it's also got a defined contribution component and account balance that was contributed to in the form of matching contributions if you're in UMPIP, and then non-matching contributions, a percentage based off your plan compensation. So a real important plan. We'll begin with that, but then we'll go back in time, the period from 1982 through the end of 2006, the ministerial pension plan, and that is an account balance. If you are looking at, for example, a normal retirement age 65, you don't need to take MPP yet. You can wait up until age 72. If you need this income right now, the way it exists right now, 65% becomes a lifetime annuity. And that just means an annuity just means a source of monthly income lasting your lifetime and continuing, if elected, to your surviving spouse. But there's also an additional 35% of your balance that continues to be a cash account balance. And I'll go through the options in a few moments on that 35%. Those of you that have the, what we call now the pre-82 plan, Minister's Reserve Pension Fund, that provides a monthly benefit that lasts your lifetime. And if married at the time of your retirement, will continue to your surviving spouse. You don't have all these different annuity types to choose from. This is set by each annual conference, and I'll review what those annual conference elections are. And then Frank's going to jump in, and he's going to talk about United Methodist Personal Investment Plan. You know, it really is a voluntary defined contribution plan, a 403B plan. A lot of flexibility with that, a lot of different ways to take that out. So when you put them all together, you might be getting monthly income from several different plans. The arrow is pointing us toward CRSP. Again, those two different components, defined benefit, pension, not on your statement. Account balance, flexibility, the ability to wait until age 72 to take it out. I think it's important to focus first on the defined benefit component, because these decisions that you make are not revocable. If you've already gone into benefit access, you can cancel that transaction up until June 30th. But once June 30th rolls past, you know, those decisions, you cannot change your mind. So the defined benefit, often I get asked, Bob, I don't see it on the statement. What's the balance? And I say, Reverend, well, CRSP defined benefit is not a balance, it is a formula. And many clergy last year were relieved with significant market volatility, were very relieved to find out that CRSP DB is not impacted by any market volatility. If the market is up, the formula is the same. If the market is down, the formula is the same. It really is just very easy multiplication. We're multiplying three different factors together. The first is the denominational average compensation. We call that DAC. And what we have seen, and if anybody is running projections for a future date, what we assume is that there has been growth in the DAC. This represents the average plan compensation, but only of clergy serving full-time appointments throughout the denomination. So we know what it's going to be for those retiring this July 1st. We also know, because we calculate this 2 years in advance, what it's going to be for those retiring next July 1st, 2022. So that's the first factor that we're multiplying. Then we're looking at what we call creditable service for two different periods of time. The first period is your service years and months from January 1st, 07 through the end of 2013. You might have a full 7 years during that period. It changed due to General Conference of 2012, and that's why we have a second calculation for the second period of service beginning January 1st, 2014, all the way up into June 30th for those retiring this year of 2021. So two different periods of service, and the factors are either 1.25% for the first period or 1% for the second period of service. And I know that might sound confusing. You don't need to do the math. We can do it together. I want to walk you through an example and just explain you how is Wespath calculating my benefit, and not just how we're doing the math, but also what impacts the final result of that math. Okay, what is going to impact it? How do the decisions that you make impact that number? So in this example, we're looking at someone retiring July 1st. They've been in ministry for a long time, throughout the entire period, 100% full-time appointment. We have the 3 bullets. Those are the 3 factors we're going to be multiplying together. For the first period of service, 1.25% multiplied by the DAC, and then multiply it by a full 7 years of creditable service. So on the right in the example box, we can see that that comes out to be $6,492 a year. Now, hold on. Pensions like this are paid monthly, so we'll just do a little bit more math. We'll divide by 12, and we get a monthly dollar amount, 541. So we write that number down, we hold that number, and then we think, hey, there's service beginning January 1st, 2014. And if you notice, the difference between the 2 slides, there's not a significant difference, but I'll go back. That first bullet went from 1.25% to 1%. And the reason for that was General Conference of 2012, Wespath wanted to make sure that these plans are sustainable for future generations of retiring clergy and covering benefits for their surviving spouses. So the factor changed, but the math did not change. The same DAC, but now multiplied by 1%, and now multiplied by 7.5 years of creditable service. 7 years, 6 months, 7.5 years. You get an annual number, 5565, divided by 12 again, because it's paid monthly, and you get 464. So all you need to do now is put these 2 numbers together. And that's what we do at Wespath. We put them together. You have $1,005 a month. And you might be saying, well, Bob, that's not the number I got. I've been on benefit access. I didn't see 1,005. The decisions, the elections that you make will impact that number. 2 different things are going to impact it. 1, what is the surviving spouse benefit? What type of annuity did you choose? What percentage continues to your surviving spouse? That's 1 impactful decision. But the other that also impacts it is the cost of living adjustment. We call that a COLA. Maybe you're familiar with that. It's an annual increase in your benefit. And yes, a COLA is an important thing because of inflation. You want your monthly income to keep up and hopefully outpace the rate of inflation. You'll have COLA choices for CRSP. You'll have COLA choices for MPP. So those are 2 real important things that will impact your benefit right out of the gate. Early retirement will also impact that dollar amount. Some of you might be looking at early retirement. And let me just explain. Early retirement, in the Book of Discipline, normal retirement is age 65 or 40 years of service. Early retirement is age 62 or 30 years of service. The theory here is if you are going out on early retirement, you're going to be getting the benefit for a longer period of time. So there is a reduction based upon how early the early retirement actually is. 2 ways to look at this. Now, I mentioned that, early retirement, normal is age 65, early is age 62 or 30. Now, if the clergy person had 40 years of service, there would be no reduction. It's either a service-based reduction or an age-based reduction. So in this example, they have 35 years of creditable service. So it's going to be based upon the age, a 2-year reduction. The reduction is 0.5% per month, 6% per year. For a full 2 years, it's going to be a 12% reduction, bringing the benefit down to $884. You'll still have options on a surviving spouse benefit that will impact that amount and a COLA decision to make. So that only pertains to early retirement. So these decisions and things you should have ready when you go into benefit access. You're going to have 6 different annuities. And again, an annuity is just a series, a stream of monthly direct deposits. We consider those different annuity types you're choosing from. And I really want you to understand fully the annuity type that you've chosen. But I also want you to understand fully the 5 annuity types that you did not choose. I want you to understand them all. I think that's really important because after June 30th, you can't switch. you can't change your mind. I also want you to look at the different COLA options and understand the impact, the dollar impact on choosing a different COLA. And I think I have a good example of that, how a higher COLA or a lower COLA will impact the monthly benefit. Think about whether you want to have any money withheld from your monthly income. It is not mandatory. It is voluntary to have withholding. So maybe you haven't filed your taxes yet. I know it's been extended. If you have an accountant or a tax person, check in with them. Let them know your status is changing. Give them an idea of what your monthly income is going to look like and whether they think you should have withholding. I will show you where to indicate that later when we go into the benefit access demo. And it's something that you can always change for year 2, 2022, when you're retired actually for the full 12 months, the entire year. Banking information, have that handy. Where do you want this money to be directly deposited? It has to be directly deposited because it's safer, it's secure, it gets there faster, and it's available as cash immediately. So think about whether it's going to be a checking account, a savings account. You're going to want to identify the name of the bank, the type of account, your account number, and very important, the transit or routing number to identify that bank. So have that ready when you go into benefit access. So that's pretty heavy stuff, but I think it's important to focus on that first because the defined contribution, the account balance that does appear on your quarterly statements, that's easy, that's flexible. Those decisions you can change. You have options. You can continue to direct the investments. That's really just called self-managing. You can continue to use life stage investment management. It's available to you as a full cash distribution. You want to be careful with that from a tax and retirement planning perspective, but it's allowed. But you have other options, including rolling it over directly, consolidating it into the voluntary United Methodist Personal Investment Plan, or rolling it out of Wespath to another retirement plan. You don't need to do anything with the defined contribution part of CRSP until you reach the age of 72. And that's when basically the government has lost its patience. They want you to start taking money out. Many of the retirees I've spoken to are well into it by then. They are taking out enough to satisfy the required minimum distribution. You know, think back, that age used to be 70 and a half. That changed due to the Secure Act passed in late 2019. They extended the age when you have to start taking distributions from these types of plans. Now it's up until age 72. You can wait, you can defer, and that money would still be invested. It's not like it's frozen because you're not taking it right away at retirement. It's still invested, still self-managed, or perhaps still using life stage investment management. Upon your death, any remaining balance, and this would include the United Methodist Personal Investment Plan, this would include that 35% of MPP, which we're going to talk about, which remains a cash account balance. When you die, that money does not go to Wespath, it does not go to your annual conference or your employer or anybody but your named, designated beneficiary. And that's why it's important now to verify that information looks good, but also in your retired status with the annual conference, you want to maintain updated and accurate beneficiary designations going forward. Very easy to do on benefit access. So we've covered a lot of information on CRSP. So we'll take a breather, reflect on that. Two different components: the defined benefit to focus on first, the defined contribution account balance that's going to be there, different options. Frank, I see you've popped in. Did any questions come in that we should raise to the group?
Oh yeah, one question came in, a couple of questions came in. The first was relating to the early retirement and waiting until you attain age 65 to claim your benefits, therefore no more reduction in benefits. And that is the case. If you're at 63 now, you can defer taking the CRSP defined benefit until you attain age 65. But the thing to know is it's still going to be based on the calculation as of this year. So years of service have stopped accumulating, you're in retirement, and the denominational average compensation for this year will be the DAC that's used in the formula, but then you restore the benefit to a whole and you experience no further reduction. So that was one of the questions that we got. And then the rate of change with the DAC from year over year, the denominational average compensation, again, is going to be applied from the year in which you retire in the formula benefit. And that's, so it's not going to move along with you if you deferred. It's going to be the DAC of the year in which you retire.
Exactly right. And we've seen growth in the DAC of about 2.5% per year. I like the first question because that's something maybe to talk to EY about. It's with early retirement, if you're trying to avoid the reduction factors, you wait. And yes, you'll get the full benefit, no reduction. Like in that example, what we have, a 12% reduction, but you will have lost out on those payments. Like in my example, that person, if they waited, yes, they're going to get the fuller benefit, but they would have lost out on exactly 24 months of payments. So there is an analysis that EY can do to see how long it will take you to make up for the difference, the greater amount that you're getting. So thank you for that, Frank. We're going to continue right into the Ministerial Pension Plan, which, as you know, existed from 1982 through the end of 2006. And the benefit education team has done a lot of consultations this year and last year, and we've looked at MPP. We see sometimes significant balance. And I do remember last year very clearly, a lot of clergy were very concerned about their retirement, very concerned about these big MPP balances and with the market volatility. But when we looked closely, because MPP is very much a balance, okay? It does appear on your quarterly statement, and it has to be managed by life stage investment management. So no participant, no clergy person is self-managing their own MPP. So when we looked at it, and first we talk about CRSP, how that the DB is not impacted by market volatility. Then we actually look at the asset allocation, the diversification among different asset classes, different funds in MPP. And LifeStage is smart. It knows you are approaching retirement. It has been over a long period of time scaling back the more aggressive investments. So when we looked at that allocation, a lot of clergy were surprised but also relieved to see that a lot of that balance was in the bond funds, the fixed income funds. So that was a relief for them as well. What does it become later at retirement? Well, right now, and there could be additional choices down the road, but right now, 65% of it becomes a lifetime annuity that you can't outlive. And that just means a series of direct deposits, monthly income, lasting for your lifetime and continuing uninterrupted for your spouse's lifetime, if elected at the time of retirement. That's only 65%. So whatever your balance is, 65% becomes the annuity, lifetime. But that's not all. 35% is left over. That continues to be an account balance that you control. You have flexibility, okay? I will show you on the benefit access demo. What I see most often is the clergy person will just indicate, hey, let's roll that over right into UMPIP. And then you have all those real flexible distribution options from that 35%. So when you put them together, you got 100%. And I would encourage you to look at this from a financial planning perspective. What will your expenses look like in retirement? I know some clergy have done very detailed budgets. They have a good idea of what their housing costs and other discretionary costs are going to be. And you want to decide, hey, do you need to annuitize this right now? Do you need the income? And even a consultation I did this morning, the answer was yes, I do need this income. The bank is looking for income so that I can get a mortgage. I'm going to take this right now. I would encourage you to focus first on the 65%. Same thing. Those decisions are not revocable. You have different annuities, 6 of them. Clearly, I want you to understand them all. COLA choices. And I just want to make it clear that the decisions, the elections that you make for MPP don't have to be the same exact elections you make for CRSP defined benefit. Obviously the spouse has to be the same, but you can choose a different annuity type, a different COLA percentage for each plan. So let's look at that 65% first. It is a account balance. You are in life stage investment management. It is on your quarterly statement as a separate asset allocation, a separate pie chart. 65%. is a lifetime benefit. You can't outlive it. Whether you live to be 103, you'll still get that monthly benefit, and it can continue on to your surviving spouse, but you have to make that election at the time you commence the benefit. You have an additional COLA option with MPP. And what I will point out, for both CRSP and MPP, the default COLA is 2%. So when you go into benefit access, you're going to see 2% there, but it's not an election, it's just the default. Many clergy will keep it at 2%. Slow and steady 2% increases, hopefully outpacing inflation. MPP also gives you a 0% option. And I will explain why you might want to consider that 0%. That just means no increase in the benefit, but you also have 2, 3, 4, or 5 to choose from. 35%, again, just flexible, cash, account balance, different distribution options, decisions that you can change your mind on. But I do want to focus on those 6 different annuities. Again, there's no mistake that you can make, no annuity that you would choose and say, oh no, I picked the one that's not lifetime. They're all lifetime, and they can continue 3 of them to your surviving spouse for their lifetime if elected. So let's look at and this is just an example. This is no one's exact benefit. It is an example of a clergy person with a balance of about $400,000, 65 years old, 2% COLA, and they're looking at these different, what we call life and survivor, or sometimes joint and survivor annuities. 3 different annuities, life and 70%. So everyone's a life, and then a certain percentage is what continues to your surviving spouse. So if you look at the highest number here, it's $915. Life and 70%. You get $915 every month, 2% annual increase. You pass away, 70% of that amount goes to your spouse. And you might be thinking, well, that's not going to be enough. Let me also consider the life and 85. 2 things happen. Your amount payable to you goes down to $890, but the amount payable to the contingent annuitant is a greater percentage. They're going to get now $757. You might say, well, that's nice, but it's not enough. Let me also consider the life and 100%. That brings you down to $866, but 100%, the same income, all of it continues to the surviving spouse. The life and survivor annuities are really the standard form of payment for a married clergy person. Okay, you have 3 different single life annuity options, which are really an optional form of payment for a married clergy person, but the standard form of payment for a single clergy person. So if you are married and are choosing a single life annuity, and what might jump out at you is that these amounts are higher. Why are they higher? One person's lifetime. And we simply just don't know how long that lifetime is going to be. If you are choosing a single life annuity, your spouse needs to be well aware of that. They need to sign a waiver, understanding, agreeing, and consenting to giving up their right to receive a survivor benefit from your pension. And there might be very good reasons to do that. You know, often people will tell me things that they've been thinking about, and I think this is a good idea to think about your age, think about your health. Is your spouse older or younger? Are they in good health? Are they in bad health? You know, now is the time to make these elections. Often a clergy person will say, well, Bob, I'm retiring in 5 years. I'd like to tell you today what I want to do. I said, that's not allowed. How come? Well, in 5 years from now, do you really know what your situation looks like? Will you be married? Will you be divorced? Will you be widowed? Will you be in good health? Will your spouse be in good health? What other sources of retirement income will be available to you and your spouse and your family? Those are important considerations when you're deciding on a lifetime annuity type. So let me just go through these. The highest amount is a single life only. In this example, $1,056 per month. Clergy person picks that. They live 30 years. That's great. They got payments for 30 years. They die. It's over. It stops. Clergy person in retirement, they're single. They pick the single life annuity, and we get notified 6 months into their retirement they have passed away. Very sad. Payments stop. Doesn't seem fair. Big balance, 6 direct deposits. It stops. Now, in some cases, I've talked to clergy that are single, and they say, Bob, I have some significant health issues. I'm hoping to get better. I have a disease, cancer. an ailment that I don't know how long I'm going to be around, but I want to guarantee that payments are going to be made for at least a certain period of time. Well, there are 5-year guarantees, 5-year certain, or 10-year certain, 10-year guarantees. Now, what happens when you do that, the amount payable to you in this example is going to go down, sometimes not significantly, but payments are guaranteed. So, clergy person single picks the 5-year guarantee, they live 23 years, payments continued. The 5-year certain term is long up, payments stop upon their death. Let's say they want to guarantee payments for an extended, a 10-year period of time. They pick the 10-year certain, but they die after 7 years. Wait a minute, the 10-year guaranteed period is not up. Somebody, anybody that they've designated is going to get the payments, the monthly payments, but only for the remainder of the term. In this example, for the next 3 years. Who is that person? Anybody that you have designated. Brother, sister, mom, dad, a child, neighbor, church, friend. Age is not an important consideration. They could be significantly younger than you, same age, middle age, but guarantee means guarantee. So if that person were to predecease you, you would simply designate someone else to receive the payments, but only for the remainder of the term. So certainly a lot to consider between the life and survivor annuities and the single life annuity options. And again, the choice you make with MPP doesn't have to be the same choice as CRSP. Then you got to think about the COLA, the cost of living adjustment. And what's nice, and I'll show you this on the benefit access demo, you can click on different COLAs and you'll see those 6 annuity types, the dollar amounts will change right there. So you can see the impact of a higher COLA or the impact of a lower COLA. So how big is the COLA really is up to you with each of these plans. Again, 0, available only for MPP. The default for both is 2%, but you can go higher, 3%, 4%, or 5%. Does the COLA impact my initial benefit amount? That's a really good question. And the answer is a big yellow yes, it does. And sometimes significantly. And I have a good example because you might be thinking, well, Bob, why doesn't everybody just pick a 5% COLA? Wouldn't that be a good idea to get a 5% increase? Well, it might be, but it is going to impact your initial benefit. So we have a chart here which shows you the different COLAs, including the 0% available in MPP. And we also have the default COLA. That's this pink line here. So you see, you start out here, and this is no one's exact numbers or exact years it's going to take to cross over. It's just an example of the concept of how different COLAs impact your benefits right out of the gate, that July 1st. We're looking at a normal retirement in this example, and we'll look at maybe the extremes would be a good idea. Let's look at that orange line. That represents a 5% COLA. If you choose a 5% COLA, your monthly amount from the beginning is going to be the lowest possible benefit, but every year it's going up 5%, 5%, 5%. At some point, and I don't know exactly when, okay, EY can help you do this analysis, you could end up with the highest monthly benefit, okay? Let's look at the other extreme with MPP. If you choose a 0% COLA, 0% is going to give you a much higher benefit now, sometimes hundreds of dollars a month more. That's why you got to look at benefit access to see what the impact of a 0% COLA would be. So a much higher benefit, but it's flat and it's not going up. So eventually you will end up with the lowest monthly benefit, but you got to enjoy those higher payments. Often I've heard from clergy that say, Bob, I'm picking that 0% and here's why. I'm waiting for something else to come due. I'm waiting to get Social Security, or I'm going to wait on Social Security to get delayed retirement credits, or we have an inheritance coming, or my spouse is going to retire at that point. There'll be more income. So I'm using that 0 as a bridge to get somewhere else. So certainly a lot to think about with MPP and those, starting with, leave it on account. I wouldn't say, hey, commence MPP just for the sake of commencing it if there is a need for the income. But think carefully about all the annuity choices, understand them all, understand the impact of the COLA. And you could do this with a different approach. You can take the 35% now, that cash account balance, and wait or defer on the 65%, or do the opposite. Take the annuity now and don't do anything with the cash account balance. So again, flexibility there. You can roll over that 35%. That's what I see most common, right into the voluntary UMPIP. Or outside of Wespath, full disclosure, you're allowed to roll this over out. You want to think about that carefully because of the housing allowance exclusion, tax break that Frank will cover, and many other flexible distribution options for that 35%. So what we're doing real good here with time, we talked about CRSP, we talked about MPP. Now we're going back in time. I realize that only a few of you, maybe not all of you, have a pre-82 benefit. This is fairly straightforward, the pre-82 plan. We will calculate the benefit two different ways. Depending upon, most annual conferences will do it two ways. Not all, some we just use a formula benefit, but you have defined benefit service money, we call it DBSM, and what that has grown to and what that converts to in a lifetime annuity. But you also have really a very straightforward mathematical formula benefit. So you might be thinking, well, why are we doing it two ways? What we're trying to do at Wespath is get you the highest dollar monthly amount. So it's always going to be a lifetime benefit, and it's always going to be for conferences that have the two calculations, the greater of the two calculations, the formula benefit or the DBSM converted to an annuity. And I have, I think I do, yeah, a quick example of how that works. And this is no one's exact annual conference, but at annual conference, you might recall a past service rate is voted on. Sometimes you see it remain the same, sometimes it increases. In this example, the past service rate is 645. 3 years of pre-82 service multiplied by the past service rate gives an annual benefit of $1935. Again, it's paid monthly, divide by 12, we get $161. The DBSM was $75,000, and when you convert that, it's a bit bigger, $2,300 a year annual benefit, $192 a month. So we have the two numbers. We'll automatically send you the 192, but we'll keep an eye on that past service rate in case it keeps increasing. Eventually, at some point, we could cross you over to the formula benefit if that is a higher monthly amount. So we'll keep an eye on that going forward. You don't have all of these annuity elections to choose from. If you are single at the time of your retirement, it is a single life annuity lasting as long as you do. Does not continue to anybody else. If you are married, you see I have different percentages here. It depends upon your annual conference. Some, it's for a married participant during your Episcopal appointment at the time of your retirement when you start receiving benefits. It's either going to be in checking with your annual conference, or we can look it up when we do a benefit education consultation with you. It's either going to be life in 70, life in 75, life in 85, or life in 100%. So that is pre-82. So we've covered everything on the left, several lifetimes, several real important decisions. And now we can move over to the green circle, the United Methodist Personal Investment Plan, the voluntary plan. And Frank is going to just walk you through how that plan works, what are the different sources of money, and how they are treated, and how it really relates to the housing allowance exclusion. Frank, I'll flip over and I'll take a look at the questions, and
Okay.
We'll just continue on. But thank you. Frank O'Brien, Benefits Educator at Wespath.
It's my pleasure to be with you today. Congratulations on your upcoming retirement. And as soon as I get that presenter.
Yep. Here you go, Frank, and I'll confirm that I can see your screen.
Yeah, confirm that and I'll advance it.
Yep, looking good.
Yeah, thank you very much. So we did have a few questions. I'll hit them real fast. One individual asked if their account balances, if you have the ability or eligibility to roll your account balances out to another investment. You are able to do that. But what we'll talk about is making sure that you understand the housing allowance as it relates to that. Then also, I just confirmed that if you're under age 65, don't do anything. That's how you defer your benefits. You don't have to worry about any of that. So we will just continue on now with UMPIP, United Methodist Personal Investment Plan, UMPIP or UMPIP. As Bob indicated, we love our acronyms here at Wespath. This plan is a defined contribution 403B plan. For the most part, it is a plan that's available for participant contributions, but certainly through the course of your ministry, you may have been receiving employer contributions in the UMPIP as well, just maybe through arrangement with your church, or if you were in extension ministries or something like that for a while. But primarily, it's a personal investment plan. We'll talk about that. It's a flexible plan. You can direct how you want the plan, your accounts to be invested. We're using the Wespath funds. You can also determine what account. Now you're kind of coming out of it, but in the past, you can figure out what account you wanted to contribute into. But the thing to know, it's also a highly regulated plan because it is governed by the IRS and Department of Labor and all that good stuff. So here we have the participant contributions that are currently available in the UMPIP, and I'm sure many of you have taken advantage of. My guess is, because of who we're dealing with right now, most people took advantage of the before tax contribution account, but maybe some jumped into Roth when it became available after tax, or the rollovers. We'll talk about the three accounts first quickly, and the words kind of tell us what's going on there. You have the before tax contribution account. That means you got your pay for any taxes were taken, an amount was calculated, either a dollar amount you gave us or a percentage of pay you gave us. That got calculated, taken out, put into the plan, and then taxes were taken out of the rest. After taxes, where that amount came in, and then all the taxes were taken out, and then either a dollar amount or a percentage was then taken and put into the plan. With the Roth account, the actual calculation from your pay is done as if it was a before tax contribution. So you get a higher amount of either the dollar that you requested or the percentage that you requested. You're going to be there. That's going to go out. And then again, the taxes will get paid. Taxes get paid, excuse me. And then we take the dollar amount and put that into the Roth account. And there's tax advantages to the Roth account that I'm going to get into momentarily. Now, as far as the rollover is concerned, as of right now, you can roll into UMPIP other qualified retirement plan accounts like 401ks, 403bs, government 457 plans, or traditional IRAs, not Roth IRAs, but traditional Roth IRAs. You can roll that in and consolidate all of your retirement assets under the UMPIP umbrella. You could do that now. You can do that later. Later in retirement, if your plan is such where you want to start consolidating things later on. Right now, you just want to focus on Wespath. That's fine. You'll be able to roll that money in later on. But again, really for today's purposes, you've been contributing all along. Now you're going to start taking distributions. And how is that going to work relative to taxes? Well, for the before tax contribution account, remember, before taxes were taken, that money was put out. So it was never taxed as a contribution. Those dollars came out. And any of the earnings, that's also yet to be taxed. That's all been tax deferred as well. So as you're taking distributions from the before tax account, it's subject to taxation, ordinary income taxes. However, I'm going to talk about the housing allowance momentarily. The housing allowance will apply to those distributions. So maybe a modest amount of it, maybe a lot of it, maybe all of it actually could be applied to the housing allowance, and really none of it gets exposed to any taxation. With the Roth account, as I indicated, the way that it is structured, if it's structured correctly, it becomes what we call a qualified Roth account, and you can take distributions from that account tax-free. For it to be qualified, two things have to happen. One, you have to be over age 59 and a half. The second is the first contribution has to be in the plan for at least 5 years. So there's a 5-year age up on that first contribution. Not every contribution, not every year's contribution, just that very first one. If that is over 5 years old, you're over age 59 and a half, you can take distributions from your Roth account tax-free. If you were contributing on an after-tax basis, again, all the taxes came out, then we got the contribution and put it in. So that's already been taxed. So your contribution will not be taxed again. But any of the earnings that it experienced, that's been tax deferred. So that will get taxed as you take distributions from your after-tax account. And that'll happen pro-rata. Getting an amount, some will be that contribution that will come out tax-free. The remaining will be that earnings will be subject to taxation. And again, due to the housing allowance tax advantage that you have, you may not pay taxes on all of that or any of that, just depending upon how your tax year works that year. While you're taking distributions from UMPIP, there's a great deal of flexibility here. You have a lot of options available. You can take a full lump sum, and you can take a partial lump sum. So a lot of people, as they're going into ministry, maybe purchasing a home and taking advantage of those retirement assets to do so. We always put a bit of a red flag on taking full and partial lump sums for a couple of reasons. And one is the housing allowance tax advantage. Once that money is out, it can't come back in and then take advantage of the housing allowance exclusion later on. That money is out. And secondly, in the year in which you take out a chunk of that money, your ordinary income tax rate may jump up to a higher bracket. Now, they're pretty broad right now, but you never know down the road how that's going to look. But you know, it's available to you. Or you can take out cash installments. You can figure that out on your own and self-manage your installments and say, I need $1,200 a month. You tell our retirement team that, and we'll set you up for $1,200 a month installments. Or you could say, Wespath, I'd like you guys to figure out what my monthly installment is going to be available for me for a long period of time. And we have the Life Stage Retirement Income Program I'm going to discuss. That is a program that will do that, provide installments for you for a long period of time through retirement. Right now in ministry, you have a loan provision available to you out of UMPIP. You can go in, you can get a calculated amount. It's regulated and fixed and all, but you can get a loan out. And then you get this for a purchase of a primary residence. You can amortize that loan for 15 years. If it's for any other reason, general purpose, you have a 5-year loan. That loan provision is also available to you in retirement. We have your banking information, and we'll just make sure that we get those loan repayments. So going early into retirement, you may want to take that trip or fix the roof. You can actually just maybe take out a loan, do that, pay it back to yourself with interest, and use it later on in retirement. As was mentioned a couple of times already, these are account balance arrangements in UMPIP. If you and your spouse pass away, your named designated beneficiaries will receive a benefit for you. What was also mentioned by Bob earlier is the required minimum distributions, or RMDs. And you are able to leave these dollars on account until you attain age 72. The way the regulation works is you have to begin receiving required minimum distributions no later than the April 1st following the year in which you turned age 72. So you can do it in the year you turn age 72, you have until April 1st of the following year. If your plan is such to wait till the following year, just know in that following year, you'll take 2 RMDs. The one for the year in which you turn 72, and then that next subsequent year will also have an RMD. How the RMD is calculated, there's a table that you can see in IRS publication 590 as to what the percentage is on in a given year, given age that you have to pay. And we simply just look at the market value at the end of a calendar year. And we take that market value, apply the percentage that's on that table, and that's the amount of required minimum distribution that you'll have. Again, this applies to all of your accounts and all of your benefits too. If you were deferring the MPP 65%, all of a sudden you're age 72, we'll contact you because we need to start to initiate that annuity because you need to start to get that money out. If it's the account balance area, we'll also contact you, make sure you begin to take distributions out so you're not exposed to any tax penalties if you don't take the RMD, and it's hefty. It's 50% of that distribution amount on top of your ordinary income taxes is going to be taxed. But we work with you. We make sure that that does not happen. Now, if you take distributions as full or partial distributions from your retirement plan, and these are monies that are eligible for rollover treatment, even though that's not why you're using it, there is a 20% tax withholding that does apply there. For the required minimum distributions, there is a 10% that also applies there. You can make the request for us to take out more in taxes if that's how you want to work it with your tax advisor, your CPA, but a minimum is going to have to come out of 20% or 10% respectively. How that impacts the housing allowance is going to be really looking at where you are relative to the 3 numbers you can apply to housing allowance that I'll get to. And the reason why I'm saying that as an aside right now is an individual did ask a question around how the 20% and the housing allowance come into play together, and I'll talk about that momentarily. So we have life stage retirement income. We have 2 life stage programs. Bob talked about life stage investment management, where we're working with you, tailoring with you, or managing MPP assets in our Wespath funds, and we're tailoring those allocations to get you to and through retirement. But we also have the life stage retirement income program. And this is a program where you look to us for us to develop an installment plan for you for the long haul through retirement. It isn't a 5-year program or a 7-year program. We're applying the principles of an annuity, the principles of actuarial mathematics and mortality tables, and we're coming up with a way in which we can derive an amount today for next year to get you installments, but do it in such a way that we can get those installments out to you for a long period of time. Now, this is not guaranteed like the annuity payment, so if you live well into your 90s, you could deplete the account, but that's not a bad thing because you've lived a nice long retirement. What we do is we look at your account balances, We understand the markets, we understand domestic inflation, and we run a lot of modeling scenarios to determine what would be the amount available to you in a really bad market, in a really good market, and then we split the difference. So we call it a payment safety zone. I'm like splitting the goalposts. You have the low markets, you have the high markets, are kind of in the middle. It's intended to give you an increase of 1.5% to 2% each year, to have some pacing with inflation. It is invested in life stage investment management in the market, so you could have a year where, due to markets declines, the number could stay flat or even go down a little. But we know markets come back, and then we should be able to get that for you as well. So it's a great program. This is certainly something to talk to EY Financial Planning about, or a benefit educator in one of these benefit consultations that we're doing to get a little more detail on this program. But really, it's another autopilot program where we're working with you and we're providing the benefit for you over the long haul. The housing allowance exclusion tax advantage that is available to clergy truly is a great tax advantage. The way it works in retirement is very similar to how it works while you were in ministry. The IRS is going to look at 3 numbers. Here now you're in retirement, the first number is going to be, what did you receive from Wespath as retirement income in a particular year? And you'll know that because in the next January, we'll provide for you a tax form 1099-R. So you'll know what you got from us. And then your actual amount expended on your housing. So you want to keep good records because you want that number to go north, because this is the lowest of these 3 numbers. So you want all these numbers to go high. And then the fair rental value of your home in your neighborhood, fully furnished with utilities. You know, our best practice, what we recommend the most, is to go into a local realtor and just have them provide you what they call a comparison letter or a comp letter. And then you can have that on file as to what you could rent your house for. Some people say you can use a Zillow or what have you, whatever you're most comfortable with. But now you've derived these 3 numbers, and it is the least of those 3 numbers that you can use in a given year. And I have an example of that. But before moving on, I want to point out that secondary bullet that's in there. As far as the declaration of eligibility for housing allowance is concerned, that is handled each year by your annual conference, at annual conference, in your annual conference journal. There is a resolution in there that says what we provide to our retirees in the next calendar year is eligible for the housing allowance exclusion. And that happens year over year over year. So you don't have to actually do anything yourselves, although it might be a good idea to just grab a copy of that journal and just put it in your file so you have it there if anybody wants to see it. But you yourself don't really have to do anything. It's taken care of that. Your annual conference takes care of that for you. You should have, many of you should have received, we've sent out kits at your individual annual conference retirement affairs. You may have seen these things at other events where we have this housing allowance exclusion worksheet. As Bob indicated, this is actually attached to the webinar, so you can grab the PDF and download it onto your laptop if you like. And on this worksheet right here is where you would fill in what you received from us, what your actual housing is, and then what the fair rental value of your house is. And you can see those numbers right there, something you can work with your tax advisor just to make sure it's all clean, but that's really for your purposes. So in looking at this and having filled it out, we see an example where someone received $24,000 in pension from us. $20,000 is what they spent on their housing. The fair rental value is $21,000 that they can receive over the course of the year for renting their home. Well, you figured all those numbers out and you know it is the lowest of those 3 numbers, so it's $20,000. So that leaves the $4,000 in this example as the amount that's taxable. But just remember, you're bringing that into the tax season. There's other reductions and exclusions and credits and all that could become available to you. So it may not be all that $4,000 is actually taxable, but that's what you know. Slicing off that original amount, what's remaining then goes into that year's tax season. The housing allowance is available to retired clergy. It's not applicable to surviving spouses unless they are a clergy couple. If you're a clergy couple, then both have the housing allowance. But if you have a layperson as your spouse, the year in which the clergy person passes away, then the housing allowance is no longer eligible. On this form, also, you'll see that we have a note on the 4th paragraph. I have it a little bit highlighted. I'm not going to read it, but it's just some legal technical language that your accountant tax preparer should just attach to your 1040. It just says, tells anybody who's looking at your tax forms that you have a housing allowance, you've taken it, and the amount that you've taken is housing allowance in that year. And again, the conference journal is where you can find that eligibility for housing allowance exclusion. Now, we've gone through all of this, calculations and elections, and we kind of understand some of the taxes to the extent and housing allowance. but you want to find out when are you going to start to actually receive the benefits. Well, we do this as of July 1st of each year, as you know. 6/30 is the cutoff. And we try to get those payments out to you as quickly as possible. This year, July 4th, we always have to deal with July 4th, but this year, July 4th is on a Sunday. The federal holiday with the banking system being closed is Monday the 5th. So we're giving you an estimate of July 9th. So I would just say the end of that first week in July, after the 4th of July weekend, you'll receive your benefit payments. But going forward, your guaranteed income, your CRSP DB, the MPP 65% if you have pre-82, that income will arrive in your bank account on the first business day of each month. Any cash installments that you're receiving, either you're self-managing and telling us you want that $1,200, or you're using life stage retirement income, that will arrive on the second business day of each month. And you can know that going forward, that the money is going to be there for you in the beginning of each month. Now, quickly before I wrap up and hand it back to Bob for the VA demo, we want to talk about the comprehensive protection plan. In retirement, you still retain a death benefit. To be eligible for the death benefit retirement, you had to receive a clergy retirement benefit at the time of your retirement. And then for 25 years, you have to have CPP participation. So if you've been with us for 38, 40 years, and for 25 of those years, CPP, you're eligible. But for people who may not be with us that long or just didn't get into CPP until later on, 12 of the last 15 years, if you are in CPP, you're eligible for the benefit in retirement. So it's 25 years or the 12 of the last 15, plus overall eligibility for benefits, and you receive your death benefit. This is a recap just right now, is while you're in active ministry, if something were to happen, the clergy person passes, $50,000 would go to the spouse. The spouse passes before the clergy person, 20% of the denominational average compensation would go to the clergy person. The instance where the clergy person passed, so you have the surviving spouse passes, 15% of the DAC will be provided to that person's named beneficiaries. And in the unfortunate event of an eligible child passing away, then 10% of the DAC would be provided to either the clergy person or surviving spouse as the beneficiary of that. For going into retirement, again, you have the death benefit available to you. For 2021, you can see those dollars. And it's the same thing with the individuals on the left-hand side. Clergy person passes away, that amount would go to the spouse. The spouse passes away, the amount, that $15,606, would go to the clergy person. In the instance where the clergy person passed, the spouse got the benefit, is now the surviving spouse, and that person passes, $10,404 would be provided to that person's named beneficiaries. And again, if an eligible child were to pass, then an amount would be provided to either the clergy person or surviving spouse as a death benefit. These benefits were increased 2% on January 1st as of this year. And right now it's structured for every year, every 4 years thereafter. But we do have a proposal in front of General Conference to increase that 2% each year. So whenever we have a General Conference, we'll find out if that proposal gets accepted or not. But no, there'll be a 2% every 4 year at a minimum anyway. We've talked about beneficiary designations a few times. Please make sure they are in good working order. If something would happen to you, something happened to you and your spouse early on in retirement, it's tragic, don't want to talk about it, but you want to make sure that your beneficiaries are in good working order so that the people you want to receive the benefits, or even the places you want to receive the benefits, will get that in short order. If they're not in good working order, then it's going to drop down to an estate, and the estate's going to go to probate court in your state, and it's going to take time and money to get that out. So take a look at benefit access, see what you have with Wespath. Take a look at your life insurance policies. Take a look at other retirement arrangements your spouse might have. Any investment that can have the beneficiary attached, just take the time to make sure they're set up the way you want them to be set up. We've talked about EY Financial Planning Services, truly a great program that is available to all of us at Wespath. They provide comprehensive, holistic household financial planning services for our participants, their spouses, their household. It is confidential. These are professional, certified individuals, CFPs and such, that will sit and work with you and go over your particular financial situation. We have the Wespath family of funds. There's a thing called operating expenses, which kicks off a small percentage of dollars that allows us to pay the overhead for the organization. That's how we pay for EY. So there's no additional cost to you. There's no out-of-pocket expense to you, and it's not limited. You can use them on an unlimited basis, number of times to use them, number of hours to use them. There's no threshold that you cross over and then all of a sudden we start charging you or they start charging. It's going to be objective advice. They're not going to look at some of the things you have and tell you they have better life insurance policies or commercial annuities. They're not going to do that. It's just objective advice. They're not trying to sell you anything. Get yourself familiar with them. Go on wespath.eynavigate.com. They have some Q&A for you. You might be able to take a look to see how you are as an investor, what's your risk tolerance. You can do those kinds of things. But certainly give them a call. Call the 800-360-2539 number. Begin the conversation with them if you haven't. Again, as Bob indicated, you want to focus in on that guaranteed income, that lifetime income area there. Make sure you're making those elections. Your account balances, you can just kind of leave as they are right now. Leave them invested. Let them cook in the funds, and then working with an EY, you can figure out how you want to derive income from those funds later on. We also have the one-on-one benefit consultations. Hopefully some of you have already taken advantage of that. Again, it's you can see the web link there. It ends in 2021 benefit consultations. And you meet with either myself or Bob. That's Todd Krevison, who's actually on the webinar behind the scenes helping out with questions. You meet with us for 30 minutes and we can go through your particular account, your particular projections, benefit access accounts, walk you through how to make your elections on benefit access, and really anything that may come up. We may steer you back to your annual conference or an accountant or back to EY, but still I think having that conversation with us prepares you to understand the questions you should be asking of those other resources that are available to you. So quickly, action planning. If you're not on benefit access, please get on benefit access. If you are, but you're not much of a user, get on there over the weekend, start playing around with it, navigating, taking a look, getting a good feel for it. You don't want to wait till the last minute to do that and get that extra stress on top of you. Take a look at your life stage investment management profile on benefit access. If you're using life stage, you really just want to confirm that you are your risk tolerance is moderate, conservative, aggressive. You can always change that. You can just continue to project your own retirement income and use the tools that are available to us. You have EY Navigate website, benefit education consultations that I just mentioned. So with that, I think I will now pass this back over to Bob. There may be some questions that we want to socialize with everyone and then go into the BA demo.
Thank you, Frank. Just one question I'll raise up to the group regarding the EY financial planning services, such a great benefit. What do I need to do to be eligible for EY services in retirement? Very easy. Just you need to maintain a balance of $10,000 in your cash accounts to continue to be eligible for EY services. Another good reason to keep your money with Wespath. You want to keep those services like LifeStage, EY, even the loan provision, which is available in your retired status. You can borrow as opposed to taking a distribution, which sometimes is to your advantage, maybe for securing housing in retirement. So Frank, if you can let me know.
Yep, I'm seeing benefit access. Yep.
Okay, so you see the screen. Yeah, this is the optional segment. As I had mentioned, many of you might not need this, but I wanted to, we always do this at retirement seminars on site, and now we've been doing it in webinars, just showing the participants where they need to go in benefit access to make these important elections. So I'll just walk you through maybe two different functionality or features of it. I've already logged on to benefit access. This is no one's balance, no one's exact benefits. It's just a sample clergy person for when you get into benefit access, you're going to see this summary of the different components, maybe health, retirement, and obviously we're interested in retirement. We click on retirement details. It gives you greater or more information. I want to view those account and plan details. In the demo, it's going to be retrieving data. And there is the guy with the glasses. So you have a nice summary of your plan balances, the asset allocation, a lot of information right there, but I want to get to the guy with the glasses. I click anywhere in that box. And if you're not retiring, you don't have that box. So if you are retiring and don't see it, contact the retirement team. But all the cases I've done this year with consultations, the box has been there. First thing you're going to see is just a summary of your retirement benefits, which are breakdown. This is going to be updated every day. These are daily valued funds. Your account balances are calculated and updated, the account balance plans. So you have a breakdown of the annuity, the lifetime payments. That's on the left. Pre-82, CRSP, the pension, defined benefit, the 65% of MPP. What is that going to give me on a monthly basis? And then it has an amount for the account balances, calculated using life stage retirement income, which you might not want to do. You might want to self-manage. You might want to take out more than that suggested amount. You might want to take out less. You might want to wait. And then you have a total for the monthly payments. Now, this benefit access demo has been real busy. It's been used in about 25 annual conferences over the last month and a half. So we see the lifetime income plans. We see a couple boxes that say get started, and one says pending. What does that pending mean? It means that this clergy person has gone in and made an election for MPP, but now they've changed their mind. It's only May 6th. Nothing has happened. It's just waiting for the calendar to turn to June 30th. So first order of business, I'm going to go in and cancel and show you how to cancel a pending action. It is easy. You click on pending. It's going to say, hey, which action do you want to cancel? I'm going to say, well, I want to change that MPP annuity. I understand it better now. I'm going to do a different COLA, a different annuity type. Are you sure you want to cancel? Yes, I do. And now I cancel it. And now I'm only going to have one more pending action. And I'm going to get rid of that one too, because I want to go through it with you. Life stage retirement income was set up, but I'm rethinking this. So I'm going to say cancel that one too. Take it away. It hasn't started yet. Nothing's happened. And I want to cancel that pending action. So now when I go back in through the account summary, find the box, it's going to be gone. It's just going to say get started. So eventually you're going to want to work your way through each of these plans. It's only going to show you the plans you're eligible for. So now I have 3 get started. Clergy 4 has everything. So let's go through one of these together. And I do like to do the MPP because I can show you about that 35% that you can roll over. So I'm going to say get started in MPP. It's going to say, all right, here is your annuity option. What would you like to do? We have your current balance. 65% of it is $269. I'm going to say, yep, let's get started on that annuity. And you'll notice, if you have done this already, that it becomes very repetitive. It's going to ask you the same sequence of questions. You know, when do you want to start it? Verify your spouse, verify the last 4 of your Social Security, make an election, tax withholding, banking information, verify, and submit. And then it becomes that pending action. So I'm going to say July 1 is when I want to start to receive income, and I'm going to simply click on continue. Now it's going to talk about the spouse. Your spouse's information likely will be there. If it's not, call the retirement team. Let me check that real carefully. Janice ITR is in there. So I'm simply going to click on I verify that that information is correct. It's going to ask you this, unfortunately, for every one of the plans. I click on continue, and then it's going to bring me to the form of benefit. And you'll notice those 6 different annuity options that we talked about. Wait, one is checked already. That's the default. It's not an election. You could change that. It's going to say life and 70. I'm going to say, you know what? Let's make that life and 85. But we also have that second choice. What about the COLA? What do you want to do with the COLA? And here's where it gets fun. You can say, well, that amount life in 85 now is 718, but what if I made that a 3% COLA? Right away, those numbers change. You can see the impact of a higher COLA, but now we can also have fun and say, wait, what about that 0% COLA? Wow, now my benefit has gone up. Okay, I'm going to leave it at 2% for no particular reason. That's what was there. That is the default. I'm going to just move on and say I'm happy with life in 85, 2%. Then it's going to really think about, hey, am I dealing with the right person? Let me double check security, put in the last 4, and you'll notice it verifies this is a match very quickly. It's going to ask about taxes. Do you want taxes withheld? I'm just going to indicate the state where Frank and I live. And, you know, this is something, you talk to your tax preparers if you have one. Think about, you can always change this. It is not mandatory, like Frank mentioned on RMDs and partial and full distributions, mandatory withholding, not on your monthly payments, just not the case. Certainly voluntary if you want to indicate marital status, total number of allowances, or an additional amount you want withheld, you can do so. I'm just going to say no. I might change that. I'll just say check here if you do not want federal income taxes withheld from your payments. Now it's going to ask, and thankfully this is already in there because I've entered it a lot. I got the bank. I want to make sure I got the name right, the type of account, transit or routing number, very important, account number identifying your particular account. The phone number, not so important. It'll let you continue without the phone number. Certainly if you have it, you can put it in there. If you don't know where your checking, transit, routing number comes from, if you have a physical check, an old-fashioned check, it would be right there, typically in the lower left-hand side of that check. Always want to make sure that's right. Call up your bank if you need to, or stop by. Just make sure that that is there because it's so important. So you click on submit. It's going to ask you just kind of take a break, step back, look at it, make sure everything looks to your satisfaction. July 1st, I got the spouse, life in 85, left it at 2%. I'm scrolling down personal information. That's actually the address where Glenview, where Wespath is located. I got my state of residence, I got the bank, and I'm looking good. And this is where the computer can be very patient. It will just wait until it's not going to let you click submit. It's not lit up yet. It's going to wait until you actually says, all right, I have read and agreed to the terms and conditions of the MPP annuity. And it's going to ask you for each one of those to do that. Just check that box or nothing's going to happen. It's never going to become that pending action, which is what we desire. And now I get a confirmation number. I can write that down. What I do is I would just right click and print that screen. You will get an email confirmation of what's occurred. And you're feeling pretty good. You got one done. You might want to take a break, but you might want to continue on and do them all. I had a consultation this morning where the clergy person had all pending actions for the lifetime benefits, but really and now you see that it's turned to pending. I have to get started on the other two, but the only one that she did not have filled out was the account balance. She really wanted to ask a lot of questions about the reserve, setting up the reserve, the impact of a reserve amount, what are the advantages of setting up the reserve. So I'm going to walk you through signing up for life stage retirement income. And you might say, well, wait a minute, Bob, I am not interested in life stage. That's not enough. I need more money, or I need less. That's too much. Or I don't want to take out balances yet. I'm going to wait a few years. That's fine. So it's not mandatory. And I'll bring this up because it came up last week on a consultation. Clergy couple, and they were both retiring. One was 65, one was 62. The 65 normal was going to take the benefits. The other one was going to wait. So they said, what do I need to do? I'm going to wait. Well, I said, you don't need to do anything. I don't have to call Wespath, go in benefit access and say I'm waiting. No, just don't go in and click on get started. Now, if you're not interested in life stage retirement income, further down, I want to self-manage. Self-manage just means you're going to tell Wespath what you want to do. I am interested in that life stage. I've heard good things about it. I went to a webinar. I want to sign up for that, but I know I'm not locked in. I know I can change my mind. I know I can get out of it. And I also know that there's no cost or transaction fees. It explains to you. Participants, there's just 3 easy steps. You got to agree to consolidate your accounts. What accounts? 35% of MPP. I've done that already. I indicated roll it over. That CRSP DC balance and the UMPIP becomes one big balance. I've consolidated. Then I'm going to think about a reserve amount, provide banking information, and that equals monthly direct deposits, ultimately cash in your pocketbook or wallet. So I understand the steps. I click on get started. It's going to ask consolidate accounts. It's going to have a breakdown of those accounts. I'm looking good. I understand this. It's got a dollar amount. I'm going to roll over, and here's why I indicate. I can say, no, don't roll it over, or roll over that 35%. I'm going to do that because I want that included. I'm going to scroll down and click continue. And now it's going to ask me to think about setting money aside, a reserve. I like to call it a rainy day fund. I have heard a lot of retirees talk to the class that is retiring, and inevitably they say there were expenses that we did not anticipate year one. When you set aside a reserve amount, and that can be up to 20% of your consolidated balance, that money is still invested, but more conservatively, but it's available for you. Let's say you got to fix the roof. You need a $5,000 partial distribution. You take it out of the reserve. You want to go on a great vacation that you've put off, $3,000, take it out of the reserve. And the impact is it doesn't change your monthly benefit. If you don't set aside a reserve and take a partial, which you're allowed to do, this is still your money. You can take it out at any time, all of it, get out of life stage. But what you can do, if you're interested, is just kind of play around with different reserve amounts. I'm going to start off putting in $20,000, recalculate. My amount goes down to $9,864. Wow, okay, that's not too bad. I'm going to say I'd like to do a $30,000 reserve amount. Recalculate. Hey, I like that. Now I know I can fall back on that money, still get that 837. Life Stage is trying to give me an increase every year. I sure like that idea. And I'm going to simply click continue. When do I want to begin payments? Doesn't have to be July 1, but I want it to be July 1. So I say July 1, I click continue. Got to verify the last four again. Matches it real quick. Do I want income tax withholding? Kind of same pattern. I'm going to check no. It maintains the state of residence. That's good. Then it's going to ask me, where do you want that direct deposit to go to? Same information is already there. I want the same bank. It makes sense. I'll click on continue. Now it's just going to say, hey, step back, take a breath, take a look at it. Even though I know it's May 6th, I can cancel it. I still want to verify 35% rolled over, $30,000 reserve, approximate estimated monthly income beginning July 1st, no taxes withheld. I got the bank. And again, the computer is going to wait you out. You got to say, I've read and agree to the terms and conditions. I click submit. I will get a confirmation number, which I can write down or print, email confirmation, and now I'm going to have a pending action. So I'm feeling pretty good about everything. I can go and I can complete the rest of them. I can cancel that at any time. I can go on and make elections now for CRSP. And I'm not going to go through CRSP in the interest of time, but it's the same series of screens you're going to go through, same type of questions, banking information, tax withholding, verify spouse, verify last four of your social. What is your annuity type? What is the COLA for CRSP? So this has been just a great webinar. You know, we had over 100 participants, which is great. I hope that a lot of you will take advantage. I did send out the link to everyone in the question box. We hope you sign up and register for those one-on-one consultations. We still have time to talk to the benefit educators, to talk to EY. Frank, I'll ask, did any questions come up about the benefit access demo?
No questions came up about the demo, but I did reinforce a couple of times to take advantage of the benefit education consultation, so we can work with people as they're thinking about elections, making elections, how to navigate benefit access, that kind of thing.
Yes, and a reminder, this has been recorded. We will provide you with the recording link for your viewing pleasure if you want to watch it again. But in closing, I just want to again congratulate you on your upcoming retirement. You know, on behalf of Wespath and specifically the benefit education team, we've enjoyed working with your annual conferences, and I just want to thank you for all your thousands of years of service on this webinar, for your ministry, and for all the good things that you've done. And I just wish you the best retirement. And if there's anything we can do, on behalf of me and Frank, to make this process easier, you know, we're here and we're going to continue to care for those who serve going forward. But signing off from Long Island, we have Frank O'Brien and Bob Christoffel, and I just want to thank you again for your participation.